also unlimited. The risk is also unlimited to equity shareholders. Okay. So like the difference of between equity shareholders and preference share, the first point is maturity period of equity preference shares have a maturity period, and there is no maturity period of equity shareholders. The fixed rate of dividend for preference shares, there is no fixed percentage of dividend for equity shareholders. Their returns are unlimited, risk is also unlimited. But here the risk is very limited to compare to preferred equity shares. The third one is residual claims on assets. If the firm going to liquidate, the first priority given to this preferred shareholders, last priority given to this equity shareholders. Residual claim on income. Residual claim on assets, control of management. Preference shareholders does not have any voting right, whereas preference shareholders have its voting rights. Either 1 share or 10 share or 1 lakh shares, every shareholders have its own voting rights in equity shares. But preference shares, there is no voting right. They can't participate company day-to-day operations. And advantages is company point of view, investor point of view, company point of view is why the companies are issuing the preference shares is the return is fixed. Nothing but the fixed dividend is there for preference shareholders. And also there is a maturity period as there. After maturity period, the firm has to repay its amount. Okay, investor point of view is also good. Why? Because if the company doesn't is equity is risky, if they want to moderate the risk, they can go for preference shares. So it is fixed rate of dividend is there, and it is a superiority of equity security over equity shares are there. Some security is there. Disadvantage company point of view also there, and the shareholder point of disadvantage is that there is no much difference between debentures and preference shares as per investor point of view. The dividends are 2 types. As per the preference shares are classified into 4 different categories. First one is based on the dividend. There is a cumulative dividend, cumulative preference shares, and non-cumulative preference shares. Cumulative means nothing but adding whatever this amount preference shares are there, preference amount is there. Dividend amount is cumulative preference shares. And second one is participation profits. Participating preference shares, not participating in profits. Redemption, redeemable and non-redeemable. Non-redeemable nothing but the permanent preference shares. We never see that non-redeemable, but non-redeemable, but until the company going liquidate, there is no redemption of preference shares. But we'll see very less cases, but we'll see more cases and redemption period, 5 years, 10 years, 15 years, 20 years period. Okay, 5, 10, 20 years, we will see that. And convertibility, convertibility nothing but the preference shares are converted into equity shares as per the company laws, as per the board of decisions. And non-convertible means there is no possible to convert equity to preference share to equity shares. Okay, so these are the some purposes. Third source of finance is debenture and bond. Debenture and bond. So we say that in a broad most of the column countries they can use the interchangeable word debenture and bonds. There are interchangeable word. Debenture nothing but debt capital. The firm has issue with the bonds or debenture to the common public or financial institution. They say that if you buy my bond or my debenture, we will pay 10% rate of interest and we will repay your amount after 5 years. So this is they are selling in papers, right? Here the problem here say that return is mentioned. So 5 years, each year 10% rate of interest, right? Reach a 10. After 5 years, the company has obligation to repay the amount, and the interest amount is also naturally paid every 6 months. So debenture holders are entitled to periodic payments, nothing but 6 months, sometimes 1 year, interest on agreed rates. There are 10 years, 8%, 10%, 8 years. 10%, and they also entitle redemption for the capital as per this agreement. So there is no permanent debt is there. So debentures are always may be redeemed after 5 years, 10 years, 15 years, 25 years, 30 years. They need to redemption. But like in preference shares, there is no voting right of these debenture holders or bond holders. The only voting right people are equity stocks. Equity stocks, common stocks, or equity shares or have the voting right. Other sources, there is no voting rights. So usually debentures are secured by change or mortgage asset of the company. They are most secured or sometimes unsecured are there. So similar the debentures, similar to preference shares, the debentures also classified security wise, secured mortgage debenture, unsecured mortgage debentures. So secured mortgage debenture are the asset by pledge, then the debentures are issued. The tenure, redeemable debentures, and perpetual or redeemable debentures. Redeemable debentures nothing but the redemption can be redeemed after 5, 10, 15, 20 years. Perpetual means permanent until the company going to liquidate and there is no redemption of these preference shares. Okay. Then third one is the mode of payments. Convertible debentures, non-convertible debentures. The convertibles also two types, partially converted, fully converted. For example, the bond value is 5 lakhs rupees. The bond value is 5,000 rupees bond value. Right? Fully converted nothing but these bond is converted or bond or debenture is converted into equity shares. Fully convertible. These, for example, these bond 50% is converted in equity and 50% is retained as a debt, debenture, partially 50% or 40%, 30% like this, or redemption. Okay. Next, zero coupon rate. Coupon nothing but interest rates. Here, what is the meaning of coupon is? Coupon nothing but interest rates. Coupon rate means interest rate. So debenture holders has a right to get fixed interest in his investment. Company has obligation to obligation to pay the interest amount. Whatever they promised, that promised amount is paid in these debenture holders. Specific rate, either 8%, 10%, or MIBOR, LIBOR. Redeemable or bearer debenture. Bearer debenture means nothing but those people having this debenture, they treat as their owners. Okay, they treat their owners. Like these debentures also categorize different types. An advantage of debentures and disadvantage of debentures. So debentures are registered. Some debentures are registered debentures and bearer debentures. Registered debentures, those debentures registered, then only they are able to get this interest amount. Bearer debenture, whoever this debenture, they will have a right to get this interest amount. See, debentures are basis of security, secured, unsecured, redeemable, convertible, non-convertible, partial debenture, partially convertible, and ordinary share like this. Then the short-term finance, trade credit, nothing but whoever the supplier or supply the raw material or goods on credit basis. The firm is paying this amount after 40 days, 50 days, sometimes 60 days. For example, see the DMart. So DMart is getting this, whatever these items are on credit basis, they won't pay and they won't be able to get. The even supplier will supply the material on credit basis only. So this is also one credit, one credit system. For example, a sugar company, the farmers supplying the sugar cane for 40 days purpose. Okay, 40 days purpose. They are supplying 40 days purpose also. That is called the trade credits. And installment credit, say that, for example, the company implementing the policy, they supply the material, whatever sell the goods on installment basis also is short term. Advances, sometimes customers will pay the amount in advance. See that now the people are paying advance. For example, Tesla car is entered, people ready to pay the advance amount, advance booking amount. Okay. Sometimes the company has to pay advance to this company also if it's a very popular or material shortage or season is coming. Like that, the advances maybe company has to pay, or sometimes company is also receiving advances. Advances are one of the source of finance. The factoring. So nowadays, the factoring everyone knows. So earlier days, what happened is how we can buy this car or properties, or earlier we buy this television equipment. How we can buy? Kalendar earlier, how we can buy?
Earlier, advance గా అమౌంట్ ఇచ్చేవాళ్ళం చేసుకునే.
So first, whatever we save the amount, then we pay and we'll get the amount, right?
Yes, sir.
So there is no third party.
Yeah.
Now, third party is there. Bajaj Finance, Muthoot Finance, Bajaj Finance. There are so many financial firms, HDFC Finance.
Yes, sir.
Okay, there are so many firms. They are intermediaries. So what they're doing is, they did is accounts receivable credit offered by the commercial bank factors. So means credit sales are converted into cash sales. Right? Bajaj Finance, we pay them, for example, we buy a laptop. What is 1 lakh, it's on finance. So EMI will pay to this HP company or will pay to the Bajaj Finance?
Bajaj Finance.
Why? Why not the company buy a product from HP company, but you pay the EMI amount to the Bajaj Finance?
Yes, sir.
The reason is the Bajaj Finance people already paid amount to the HP company.
Yes.
Right? So you suppose I'm a defaulter. Who will bear the loss here? Bajaj Finance or HP company? Who will bear the loss?
Bajaj Finance company.
Bajaj Finance.
Bajaj Finance or HP company?
No, Bajaj Finance company, sir.
Bajaj Finance, sir.
It depends upon whatever they have an agreement. Right? Suppose the company say that whatever the losses are there, losses can be transferred to HP, or say that no. It depending upon it's purely commission based. Purely commission based. So nowadays, it is one of the major, see that the car company, when the car company will get this total amount, either 5 years, 3 years, 4 years towards, right? If the car selling owned direct to the company, customer, the car company can sell the car to direct customer. There is no third party, there is no banker. So when the company get the Tata cars, they will get the total amount within the 5 years. The period is very 5 years, the longer period, right? If the television is 1 year or 18 months, the factoring is very popular nowadays in emerging countries like India. It is one of the source, right? First, HP company will receive the amount. If it is a credit sales, the company will receive the amount, but they sacrifice some percentage of commission. But still, that it's a factoring is one of the major source of finance to the companies. Accrued expenses, the expense may be accrued, like we pay, the company has to pay delay payments. So March month salary will pay in the month of April first week, right? So payments are made late. Receipts will be in advance, right? For example, you see that now if I recharge this 2,000 rupees in what we call 2,000 rupees in recharge of this metro card, I will use for next 3 months. But earlier, no, I paid the amounts, right? Before using the services, I paid the amount. At the same time, you are subscribing this Amazon Prime or subscribing the books. Before using the services, the company is receiving the amounts.
Yes, sir.
Any default is there? Any default is there in this case?
No, sir.
No defaults are there, right? No defaults. Like before using the services, the customer is paying the amount. It's one of the source, it's a good source. See, suppose we assume that Hyderabad L&T Metro, every customer has, regular customer has a deposit, recharge 2,000 rupees card for next, they're using for next 2 years, next 2 months. See that how much amount it's there for now. One customer, for example, I'm individual. I recharge 2,000. Like you see that 1 lakh people, 1 lakh people deposit recharge 2,000 rupees per a month. See what's a huge amount.
Yes.
Before users, they paid the amount, received the amount, and no need to pay any interest amount also. Right? But the default is a very limited, default is also very less. Food expense, one of the source, deferred income. So far we discussed the deferred income is also. Right? So receiving the advances before supplier goods or services. Okay. So Amazon subscriber, Amazon Prime subscriber, most of subscriptions, whatever these OTT channels are magazine, journals, right? So customers receiving the advance before supply goods or services. It is also one of the source is called as a deferred income. The commercial papers, the companies also issue the commercial papers. So India is not that popular, but the companies also paying loans, cash credits, overdraft, and discounting the bills is also available for short-term purposes. Letter of credit, it's most useful for in export imports goods. Okay. Hypothecation rates, public deposits also there. Now we'll move to second topic is cost of capital. We'll move to capital structure. For example, capital structure, right? The word is capital structure. Before move to the capital structure, now you can understand what is this balance sheet? Is the position statement, right? Here liabilities, assets are there. Here items are equity shares, liability preference shares, debentures, long-term loan, long-term loan, and like long-term loans like sundry creditors, bank OD, outstanding expenses. So like you see that the total assets also categorized into fixed assets and current assets. Any doubt here? Any
No,
doubt?
sir. No, sir. No, sir.
No, sir.
Okay. Liability side, asset side. So here, liability side, equity share, preference shares, debentures, long-term liabilities, and reserve and surplus also there, reserve and surpluses. So if you take both, so this is called financial structure of the firm. If you take both sides, both balance sheet liability side, it is called as a financial structure. If you can consider only this, only long term, it is called capital structure. And it clear the difference between financial structure and capital structure. Financial structure nothing but the total amount of balance sheet. But capital structure nothing but only long-term sources of finance. Capital structure. This is the capital structure. Okay, nothing but the portion of debt and portion of equity. What is the portion of equity and portion of debt? Now we are going to talk about this balance sheet, liability side, capital items, long-term items. Okay, am I clear or any doubts?
Yes, sir. Yes.
The difference between capital structure and finance structure. Okay, so this topic, whatever the finance topics are, we talked about in balance sheet liability side absolutely. So this is the balance sheets, liability side, asset side. Whatever the topics are there in our third block, that is the source of finance, or capital structure, cost of capital, nothing but KO, and leverages, all are under liability side only. Okay. Earlier we talked about this capital budgeting, right? The capital budget nothing but fixed asset side. The financial management nothing but we are studying the company balance sheets And the purpose is financial management purpose. How the firm is managing its finance. Okay, it's not new thing. Just read the balance sheet, understanding what the capital structure, what is the financial sources of the firm, and what is the cost of capital, what is sources of funds, is long-term sources, short-term sources. Like we are going discussing only these two. Am I clear? These. So we are in liability side of the balance sheet. Okay. So capital budgeting, asset side of the balance sheet. That too, fixed assets. Okay. So capital structure is a liability side or asset side? Kalyan garu?
Liability side, sir.
Liability side. Only capital, right? So the capital structure, nothing but to see that the capital structure, nothing but long-term debts plus preference shares, net worth, nothing but equity holders amount. Equity holders amount. So capital structure, nothing but total asset minus current liabilities is also called as capital structure. Capital structure, capital structure is a permanent finance of the firm represented by long-term debt, preference stocks, and net worth. And here one more vessel is say that the term capital structure is frequently used to indicate long-term sources of funds employed in a business. Employed, the very important word is employed. Employed. So whatever you can procure the amount. So these are the sources of finance. These are the applications of finance. So liability side, asset side, right? So ఇక్కడ డబ్బులు తీసుకొచ్చాము. ఈ డబ్బులు ఏం చేస్తున్నాం మనం? Employed, right? How we are using this amount for business purposes. For business purposes. Capital structure is the combination of both debt and equity. Both debt and equity. Debt nothing but debentures and bonds. The pattern of capital structure nothing but the firm has its own complete equity stocks, or the firm has its own only two stocks. See that in the balance sheet. In the balance sheet, the firm has its like only equity shares, no other, all equity shares, and other after this current liabilities like sundry creditors, bills payable, outstanding expenses, all are under. This is one. The second one is in the balance sheet, the two items are there: preference equity shares and preference shares. This is one. No debts. Third one is proportion of debentures and equities. Debentures and equity shares and debentures. This is one. The fourth one is combination of three: equity shares, preference shares, and debentures. Now we have four different types of balance sheets, right? So which one is better? Which one is better to the company? Is the combination of three?
Equity shares.
Fourth one?
First one, sir. Equity shares.
No, only equity is better. We have four options. Option one, only equity. Option two, equity plus preference. Option three, equity plus debentures. Option four, preference shares, equity shares, and debentures. Which option is better to the company? Which combination? Which capital structure is good?
Fourth one is, sir.
Fourth one is
better, sir.
Better compared to all.
Yes, sir.
Right? Only equity is also high risky. Earlier I told you these 100 crores are distributed all. So EPS is very limited. It is not good. I told you debt is a very cheaper source. Debt is a cheaper source, right? The firm has to debt. See that the people, right? Sometimes will increase our wealth. We take a loan. For example, see that so I'm an employee. Assume that I'm an employee. I will take a personal loan. Interest rate is 10%. I bought a land. The 10 lakhs rupees are increased 30 lakhs rupees. Right? how much amount I'm paying? I'm paying a 10 lakhs. If the interest amount is 10%, 1 lakh rupees I paid interest per year, 10%, right? So amount increased 10 lakhs to 11 lakhs rupees. I mean, 1 lakh is I paid. But whereas my asset values are increased 10 lakhs to 30 lakhs rupees. Why the 30 lakhs rupees? I'm taking advantages of interest rates. Right? Debt is a very cheap. So companies also mobilize their funds on debts. Why? Because the returns, whatever these percentage is fixed. అంటే కంపెనీకి అప్పు ఉంటే కూడా మంచిదే లేకపోతే ఏమవుతుంది there see that right, if there is no debt, there is no mandatory nahi chalta theek hai, you need to pay back, there is no burden, right? So like every firm has to either issue equity share, preferred share, debentures, but the combination is how the combination is. Again my question is like this. So as Kalyan said, combination is better, right? Equity, preference and debt, right? These combinations better. For example, the company required 100 crores. How much amount for equity? How much amount preferential? How much amount debt for Kalyan garu? Vinod garu.
40, 40, 20, sir.
40, 40, 20.
Hmm.
Or one more option. Can I go for 30, 30, 40?
Yes, sir.
Yes, sir.
Or can I go for 20, 20, 60?
Maybe.
Right? But which combination are good for the company? Which combination? The object is cost is minimization and the profits are maximized, then wealth is maximized. So which combination the firm cost is limited? Either this one or this one. Suppose we assume that this combination the cost is 12%. And this combination cost is 15%. So we will prefer this one. Why? Because the cost is only 12% and this combination 15%. Capital structure, how to construct a optimum capital structure. Optimum capital structure means where the cost of capital is less and value firm is increased. Third capital structure is called optimum capital structure. The firm has to construct the optimum capital structure. It's always better. Always better. Okay. So here capital structure is nothing but the combination of debt and equity. How much debt is, what's the best combination, right? The factor to be considered a capital structure decision, financial leverages, think about trade and equity, cost of capital, all these are there. Trading and equity, think about equity ownership of the companies. The very important one is cost of capital, right? Cost capital is not available at free of cost, right? Cost available is a free of cost of capital? No. If the firm has to issue the debentures, the company has to pay, for example, assume that 10% debentures, 10% debentures, 1 lakh rupees. What is the cost here? The cost is 10%, right? 10% on 1 lakh. The cost is in terms of money is a 10,000 rupees cost per year, right? 15% debentures. Same 10 lakhs, we assume that the 10 lakhs rupees. What is the cost here? 15,000 rupees cost here. 15,000 cost is in terms of preference rates. These two cost is 25,000 rupees cost. One more source is there. One more source, equity, right? Equity shareholders are expecting higher return than these two. Preference debentures 10%, preference shares 15%. Equity shareholders are expecting higher returns. Suppose we assume that 20%. The capital is 30 lakh, 30,000 rupees, 33 lakhs rupees capital. Right? 3 lakhs rupees into 20 by 100. How much it is? 60,000. 60,000 is cost. Right? The total is 5 lakhs rupees capital. 5 lakhs rupees capital, right? 10 lakh, 1 lakh, 1 lakh, 1 lakh. This is preference shares are 1 lakh, debentures are 1 lakh, and equity is 3 lakhs rupees. The total 5 lakhs rupees. The cost is 75,000 cost is there. 75,000 cost is there. Right? Our proportion is, suppose our proportion is 20%, 20%, 40%. Right? So like that, which combination is better? Amount is not available to free. Right? Always we focus on lesser cost and higher return. Cost ఎప్పుడు కూడా తక్కువ ఉండాలి, రిటర్న్ అనేది కూడా ఎప్పుడు ఎక్కువ ఉండాలి. So each source of finance, right, will take decision in financial management, financial decision. The target is cost of capital. If the amount is higher than the cost of capital, we are happy. Otherwise, the firm has facing a problem. Controls also required. Industry leverage. Leverage, nothing but is a loan. Sometimes say that how the firm is going to increase its industries. Seasonal variations. Some of the products are seasonal products are there, right? It is differ from period to period. You say that companies are preparing this income statement quarterly or yearly as per SEBI regulations. The companies are preparing the profit and loss accounts year-wise or quarter-wise?
Quarter-wise, sir.
Quarter-wise, right? Q1, Q2, Q3, Q4, right?
Yes, sir.
Why Q1, Q2, Q4? Why not 1 year? Why not 1 year? This is Q1, Q2, Q3, Q4. Why? And at the same time, they're preparing consolidated income statement, right? Consolidated profit and loss at the end of the year. So why they're preparing this quarter-wise? Some products are seasonal products. You can take an example of this fertilizer companies, right? Is a pure depending upon the season. After the season end, there is no growth, right? Same with the products. See that these wedding base or these air coolers, refrigerators, right? And these are some seasonal products. One season the sales are good, second season sales are limited. We can't say that this year sales are good. The season wise is 3 months, nothing but 90 days. What is the revenue is there? What is this? See that we say that yes, given is umbrella fans, air coolers, industries. Right? Seasonal product. Seasonal product, which is the season we see that. These we can't say that the tomato farmer getting abnormal return this year, the whole year. Can you say that? Tomato farmer are getting abnormal returns the whole year. Can you use the statement?
No, sir. No, sir.
No. Why? Because the seasonal commodity, seasonal product, right? The
Yes,
whole
sir.
year is not the whole year cannot sell the tomatoes at 200 rupees per kilo.
Yes,
Right?
sir.
Once the next 20 days, 30 days, if the new crop is came, automatically the price is reduced. Sugar companies and whatever these industries, some commodities are purely based on season base, raw material base. Okay, seasonal variations are there. 3 of composition, how much data, how much is there, and like you see that degree of composition, gas, electricity, and other products. Industry life cycle industry has its own life cycle, growth, maturity, and decline stage. Right now, this growing stage is we assume that AI is a growing stage. Right, like here, the stagnant stage is we say that movie theaters, or we say that cycle industry or two-wheel industry in India are in stagnation stage. Some companies are declining stage also there. Some companies are AI based increasing, right? Some industries are initial stage, some industry growth stage, some companies are maturity stage, some companies are decline stage. So it is also playing an important role for in structured capital structure. If the growth firm, they can get abnormal returns. So when see that when the firm is growing stage, having more profits, it can be more debts, less equity that helps to maximizing the wealth, maximizing the wealth of the firm, right? So here you say that in growth firm, it is a growth stage, right? In this growth stage, the firm getting higher return. Better to take more debt here. But here, in downside, we can't take any debt here. Debt is not advisable here. ఈ డౌన్ అయ్యేటప్పుడు కంపెనీకి అప్పు ఉండకూడదు, పెరిగేటప్పుడు అప్పు ఉండొచ్చు. It's growing stage, the firm can take debt. Why? Debt is a cheaper source of finance. Debt is a cheaper source of finance. They can issue the debt here, but they can't issue this. They can't mobilize debt in this what we call declining stage. Agency cost nothing but the conflict between what we call debenture holder as well as the company point of view. Okay, the management company point of view. The company characteristics, the company, what is the size of the company? Is a small scale, mid scale, or large scale company? What kind of product it is, and what kind of risk is involving in this firm, right? So, like the company characteristics also playing a very important role to construct optimum capital structure also. Timing of IPOs is also very most important. See that recently we have seen the witness of this Adani groups, Adani buybacks, right? Timing is very poor. After Adani groups, we can see only few IPOs are successful, remaining are not successful on issue of. Timing is very most important, right? And see the few companies are ready to issue of IPOs. The time when the market is bullish, okay, when the market is bullish market, nothing but rising markets, IPOs are easy to get this money. When the market is bearish markets, that people are won't buy these IPOs. The people are buying, but very limited, right? So the timing, the market is bull markets or bear markets. It is also very most important. Right? In bear market, the people move to equity to debts, equity debenture. For example, here the market is, this is a bull markets. The investors, bond holder, move to equity. If it is a bull markets, bond holder will sell the bonds and they will buy the equity stocks in bull markets. Whereas in bear markets, equity shareholders, they are selling the equities and they will buy the bonds. Why? Because in bear market, they need to reduce the risk. They are selling the equity, they move to bonds. Okay, am I clear?
Yes, sir. Following, sir.
Yes, sir.
And requirement investors, the requirement investors are different for retired persons or individuals, or the different purpose, different requirements are also there. Some people are purpose is their children education. Some people require, they want to construct a house, or they want to amount invested for the children education or marriage purposes. The purpose are different purposes, right? The tenure, if the tenure maybe 5 years, 15 years, 20 years, it depends of how these investor fund. The companies also, the company required for 15 years, 20 years. Purpose of finance. So like this is this source of finance. Optimum capital structure. Optimum capital structure to maximize the wealth of the firm and minimizing the cost of capital. It is called optimum capital structure. Cost always must be minimized and wealth must always maximized. And which combination are maximizing the value and which combination minimizing the value, right? So that part is there. Now I stop here and next Saturday we'll continue this capital structure theories. Okay.
Yes.
Okay, sir. Thank you, sir.
Right.